Hello, good evening, everyone. On behalf of Karnataka State Chartered Accountant Association, I extend a warm welcome to all of you to today's webinar on Decoding GST 2.0 Impact on Trade and Consumers. The recent 56th Council meeting has brought about significant changes, and this session is aimed to helping us understand the real impact on trade and consumers. We're truly privileged to have with us CABL Subramanya sir, a leading expert in GST, who's kindly agreed to join us at a very short notice. Thank you, sir, for accepting our request and sharing your time and expertise with us. Yes. Before we begin, let me share a few words about KSCA. Since 1957, we've been committed to empowering chartered accountants through knowledge, representation, and networking. And as a member, you gain access to enriching knowledge sessions, valuable professional development initiatives, and also strong peer networks and a powerful platform to voice issues impacting our profession. So, and if you're not a member, I warmly invite you to join KSC and be a part of the change and impact that we're creating together. I would also like to inform you about an upcoming program by our Direct Tax Committee, a full day session it is on demystifying in the new Income Tax Act 2025. Key changes and its implications are the main focus. It is scheduled for this Saturday, 20th of September 25 at Chancery Pavilion, Bengaluru. Only last few seats are remaining, so I request you to register early and not miss out this one of its kind program. Do follow our association's website and WhatsApp group for regular updates on forthcoming programs and initiatives. With that, I once again welcome you all and now request my colleague C. Sachin to introduce our distinguished speaker for the evening. Over to you, Sachin.
Harsha. Thank you, Harsha. Good evening, everyone. It gives me great pleasure to introduce our speaker for today, CA BL Subramanya. He is a chartered accountant with over 9 years of experience in indirect tax litigation and advisory, with offices in Bangalore and Chikballapur. His expertise spans over service tax in central excise, VAT, and GST. He has represented clients in consulting, notices, appeals, up to tribunal, and even supported tax writ matters in high courts. He has also contributed significantly to the profession, having served as chairman of the Indirect Tax Committee of KSCAA for 3 years, actively worked with FKCCI, authored books such as Time and Value of Supply and Echoes of Jurisprudence, and regularly shares his thoughts on taxation and professional growth. We are honored to have him with us today to decode GST 2.0 and its practical impact. With this, I hand over the session to CA Subramanya.
Yeah. Thank you, Sachin. Thank you, Harsha. Thank you, Indirect Tax Committee of KSCAA as well as KSCA for this wonderful opportunity to probably share few thoughts, perspectives, and probably the open issues, if we have to say. So I think every day we are seeing a lot of changes which are coming in, and there was a flood of notifications which were circulating in our WhatsApp since yesterday, and I think there are few more to come probably as well, which gives us the way in which this particular thing is being happening and that we are looking at. Without taking much time, maybe let me just get into the discussion on our today's topic. Is my screen visible, Harsha, Sachin?
Yes, sir.
Yeah. Yes. So just wanted to set the agenda for our discussion. So the thought processes, I have structured this into 3 sections. One, overall bird's eye view of what all changes have happened in the recent GST Council meeting. There is a 56th GST Council meeting, followed by the brief issues which are there, as in the open issues are the issues which are there, and to end with the action points that we'll have to probably look at providing our consultation to the clients. So with these 3 aspects, we will start with the discussion. So broadly, if you have to see, as we all know, there's a reduction of rates. Now, what is reduction of rates? the rate, the slab which is there at 12% is reduced to either 5 or it is exempted. It could be goods as well as services. There is a reduction of rate. Increase in rates, yes. There are few products where apparently there is an increase in rates. And since the 28% slab is also something which is taken out, few are shifted from 28 to 40. Of course, few are shifted from 28 to 18 as well, that we have seen. So these are the two things. And the last third one is exemptions. So various products, services are exempted. Each of these, reduction of rates, increase in rate, and exemptions, each of these three has a unique impact on the running of the business, and accordingly the action needs to be taken ahead. And the next new thing that they've introduced, going back to our central excise regime, is the retail sale price, that is MRP based valuation mechanism. So as we know, the valuation under GST is transaction value based. Once the transaction is between two unrelated persons and price is the sole consideration, Section 15 very clearly says that the GST has to be charged on the transaction value. However, when it comes to Section 15, there is one more section, which is 15 subsection 5, which provides the government an authority to prescribe a value for certain supplies, where they can give a different valuation mechanism. Excising the powers under Section 15 subsection 5, we have got various notifications in the recent past. For example, even the real estate notification, where it talks about the 1/3 deduction and going with the rate of 7.5%, that is also under the provisions of Section 15 subsection 5. So the retail sale price based method is also something that we may expect under the powers of Section 15 subsection 5. Now, what are these goods which are covered in this retail sale price based method? The goods are basically the tobacco products, pan masala, chewing tobacco. These products, essentially the tobacco products, are intended to be brought under the retail sale price based mechanism. To date, as on date, there is no clarity whether the retail sale price based mechanism has an abatement. Let's say a cigarette packet is carrying a price tag of 150 rupees, whether the GST at whatever rate, at 40% of course, is applied on the entire value or after an abatement is something that we are not sure. However, there is scope for a valuation as well as abatement to be also being in place. Now, what is the government achieving by this retail sale price based method? Since the manufacturer of these tobacco products would have affixed the MRP at the stage of manufacture itself as per the applicable legal metrology act, the taxes is collected on the entire sale value at the earliest point. Now think about the situation. ITC Limited, cigarette packets, 150 rupees MRP. On the entire MRP value, the taxes are in place, and every stage later on, distributor, its next seller, its next seller, its next seller, till the end customer, the input and output should essentially remain the same. That is what we are assuming, because take an example of a person who is only into cigarettes and tobacco. Effectively, his input and output will be more or less the same, because on the entire sale price, you are basically charging the taxes. And there may not be any situation, if a plain vanilla case, a person only into a sale of cigarettes will not have any output to pay in cash, correct? They have purchased, they have credit with them, as and when they sell the same value there. How the valuation will be declared? Of course, the invoice provides for, invoice as per Rule 46 provides for different clauses in the invoice. One is the taxable value and the sale value and taxable value. So in this case, the sale value will be the consideration that is charged. Taxable value will be the RSP, that is MRP based valuation, which will be there in place. As on date, there is this proposal to have this particular, there is an approval or a recommendation from the GST Council to have these products, which are basically tobacco products, into the retail sale price based method. However, since the government is not clear about probably the cess amount, the cess dues to the states for the compensation, they intend to continue these tobacco products under the existing regime. What is the existing regime? The normal GST plus cess, whatever is there, that will be continued for some more period, indefinite period. There is no clarity how many years, how many months, but the decision to basically include this particular thing into the regular system of 40% bracket is left to the decision of the finance minister and the chairperson of the GST council as to what date they want to bring it to the retail sale price method, totally obviating the requirement of cess. And the last point is there are few trade facilitation measures which are probably long pending in the discussion list, which is GST Appellate Tribunal. Yesterday, the notification has come that GST Appellate Tribunal, the due date to file the appeals before the GST Appellate Tribunal will be 30th June 2026 for all the orders which are passed before 1st April 2026, which is 3 months before the due date. And for the orders passed post 1st April, the 3-month period which is given, that is what the notification says. So I think this is something which we'll have to definitely gear up for. Registration related, there's a relaxation which will deal in detail. A different scheme appears to have been envisaged by the government to ease the registration process, especially concentrating on those who don't have much of B2B exposure. The registration related, whatever we say on the registration related issues, most of the registration related issues are concentrated, or the restrictions that they have brought in is probably to handle that 5% of people or 2% of people where some unscrupulous transactions are happening. I think this is a good move. Maybe we will discuss a little detail on the registration aspect. And there is a clarification, a much needed one. Many notices are issued. I'm sure all of us would have come across the issues that the department is raising on the discounts part. There is some clarity, which is definitely a respite, which we'll have to watch out. And the circular is also issued. That is also something that we'll discuss. Intermediary, the provision of intermediary, especially in a transaction involving one of the parties inside or outside India, there is an amendment to the place of supply provision in section 13, which is also a helpful beneficial provision which we can cover. And lastly, the provisional refunds, where the provisional refunds are basically allowed for ACZ transactions and few other categories of transactions. Earlier it was there only for certain categories of refunds. Now they have enlarged the scope for the provisional refunds, where the refund applicant can get a refund of 90% within the first 1 week of the refund application. So this is the overview that we are looking at. Now let us get into each of these products. New slab of 40%. Now what are the goods which are included in this? Mostly pan masala, non-alcoholic beverages, carbonated beverages, caffeinated beverages, tobacco, cigarettes. So out of these, the tobacco, cigarettes, pan masala rate will be increased from 28 to 40 from a future date. Basically, that future date will be decided by the chief, the finance minister, as well as the chairperson of the GST council. And of course, the 40% slab also includes all the high-end cars, which is more than 4,000 mm in size, as well as the engine capacity above 1,500 cc. Now, what is the date of implementation? Now, all these changes effective from 22nd September. So what is 22nd September? 21st is passed. 22nd September, 12:01 AM is the date on which these particular changes will be effective. Now, this 22nd September, the issue till now was the press release is issued. Press release clearly carries a line at the end saying that these are only for information purpose. It will not have a statutory force. Notifications are to be issued. Yesterday, all the notifications are issued. So there is nothing which is pending. Of course, the notifications what are issued by the central GST, there is a state GST notifications which should also actually be issued by the time 22nd September is there. As I understand, few states have already issued the state notifications as well. Chhattisgarh notifications were issued and few more states also issued. Probably Karnataka is also something, it may have been issued, or probably we will shortly see that. So the 22nd September is the date, very clearly the date to be considered. Next point we have discussed, GST tribunal we have discussed. Okay. Now, one more big challenge, or probably one recheck, is before probably conveying to the clients or adopting a particular rate, it is better to always cross-check the rate that we are seeing in the simplification table with the actual notification which is issued. One good thing about the notification is, if you have considered the earlier changes, how the notification used to come, they used to say in schedule number 1 dealing with 5% products, let's say, schedule number 2 dealing with 5 products, let's say, serial number 30 is omitted. That's how the amendment used to come. Now, how the rate notification has come, it is in supersession of the earlier notification, which means you have a fresh notification with all the entries therein. No products is missed out. So if you are looking at the applicable rate from 22nd September and onwards, you can take that particular notification which gives the rate for all the goods at one place. Need not refer back to the earlier notifications. We were also discussing why is that this particular change has come. Till now, we used to get entry number 30 deleted, entry number 34, 6 is replaced, entry is taken from here, this entry to that entry. Why is that? They have got a new notification consolidating everything as a notification. That was one more point of discussion we were having. So one thought process that came up is the schedule numbers. Earlier, schedule 1, schedule 2, schedule 3 were carrying the respective rates. Now there are schedules till schedule 7, and the rates against each of the schedule has also changed. Probably that is the reason that the notification is a completely fresh one without giving to the reference to the earlier ones. So I have not got into the goods related notification in the interest of time. That is, of course, that is available for us, which we can always cross check. I am getting into the service related aspects where certain aspects are to be considered for discussion. Now, if you see, wherever the rates are 12, be it goods or its services, all of that is taken out and it is either 5 or 18 or whatever rate, 40 or 40. And to the preliminary understanding, only one product which remains at 12% rate is the bricks and the tiles which are used over the roof. So only that particular product actually remains in 12. We'll have to see why that remained in 12. Probably that was a recent amendment which they brought in to categorize that into 12. That is something which is retained. We'll have to see if something changes even there as well. Apart from that, all goods, all services, we may not see the 12% rate at all. So job work in relation to umbrella, that is 12% with ITC, it was there, 5% with ITC. Job work, printing of goods under chapter 48 and 49. What is 48 and 49? All paper and paper products are under 48 and 49. This is definitely a good relief. 12% with ITC is reduced to 5% with ITC. How this is helping? Now, let's say notebooks are exempted now. Now, if this particular reduction was not there, what happens to the notebooks? The cost, which was 12%, see, paper and printing cost is the major one. So what happens? The printing of paper, whatever happens, that adds to the cost. How much would have been added to the cost? 12% would have been added to the cost. Now only 5% adds to the cost because the end product is exempted. However, there are few goods which upon exemption appears to be a little costly. For example, I was just discussing with one of the manufacturers who are into manufacture of crayons. So crayons are exempted, as we know. However, the wax, the pigments, the colors and the chemicals that they use are all still at 18%. Earlier, what was the rate? Most of their inputs were at 18% and their output was at 12%, which means there is an accumulation of credit which they could have used for that product, any other product, or they could have gone for a refund. Now, what is happening? Now, this particular situation has changed. The 18% cost is straight away adding to their product cost. Because it is exempted, they can't take the input tax rate of it. So they're in a position where they may have to increase the rate of the MRP. That is the current position with respect to few of the goods. The same is what I heard even with respect to the paper industry. Books are exempted. However, the paper, the 48-49 chapter paper is taxable at the same rate. Only the printing cost, job work printing cost is actually brought down. Job work on bricks 12% to 5%, pharmaceuticals 12% to 5%, job work hides and skins 12 to 5, effluent treatment plant 12 to 5, waste disposal services 12 to 5. Admission to cinema ticket again 12% with ITC to 5% with ITC. Hotel accommodation services less than 7,500 per day. It had this option of 12% with ITC. The rate itself was 12% with ITC since the hotel accommodation was there. This, as you know, it has undergone various changes. First, up to 1,000, there was one slab, 1,000 to 7,500, there was one slab. Now, the last 18 July 2022, if I'm not wrong, they have taken out this 1,000 slab. Anything which is there is taxable at the rate of 12%, up to 7,500 tariff per day. Now, this is reduced to 5% without ITC. Now, this is something which is very important for us to consider for this particular industry. Once they say that this rate is without ITC, then automatically there is one entry in this particular exemption the rate notification, which directs us to explanation 4. So wherever the input tax credit is restricted with a rate of tax, they say this particular product will be, this particular service will be deemed as exempted only for the purpose of ITC reversal. So to put in other words, let's take an example. There is a individual who runs a hotel, as well as he has some commercial place for renting. Now, commercial space for renting is 18% with ITC. There is no doubt about it. And this hotel accommodation, he is charging 2,000 rupees per day. That comes with effect of this notification to 5% without ITC. Now, as soon as this comes to 5% without ITC, this turnover of hotel accommodation will be considered as exempted. Though it is taxable at 5%, it will be considered as exempted for the purpose of determining the ITC reversal on a month-to-month basis. What is month-to-month basis? September 22 and onwards, you have got inputs, input services, capital goods you are purchasing, which is probably common for the entire business as a whole. Then you have to apply the provisions of Rule 42. And of course, since it is without ITC, the credit specifically in relation to the accommodation services will be ineligible. And any taxes which you pay under RCM as well will have to also take the same position of 5% without ITC, where hotel accommodation or these services, wherever it is given without ITC, will have to participate in the reversal under Rule 42 and 43. Next is third-party insurance of goods carriage. There, the rate of tax is reduced from 12 to 5% with ITC. This is one entry which has made which has covered a lot of sectors. Beauty and wellness services covering gym, retreat centers, all these wellness centers, where the rate of tax has been reduced from 18% with ITC to 5% without ITC. So as soon as without ITC, the same explanation of explanation 4 has to be considered. Health insurance services, individual plus reinsurance, it is exempted. We are well aware of this. Life insurance, 18% with ITC, exempt, which we are well aware of this. Of course, some issue that we will have to consider here is on the time of supply. Now, when is a health insurance supplied? Is it on the day one? Is it over a period of 1 year as a continuous supply, or is it at the end of the year when actually the period gets completed? Because that will also determine the time of supply. Generally perceived health insurance, life insurance is more of an assurance. You don't expect the eventuality or a problem to happen. So since it's a continuing one, general perception in various discussions have been that on the date of your policy start date will generally be considered as the date of provision of service, and accordingly the tax has to be determined. So the time of supply provisions also has to be accordingly considered, considering the date of start of the policy as the date of supply of service. We will come to the provisions of section 14, which deals with the rate applicable, especially for this transitional transaction, where invoice is issued before rate change, payment or supplies happen post rate change. So these three aspects, invoice, supply and payment, falling in any part of this timeline, that is before the rate change or after the rate change, is something that we will consider in the coming slides. Air transport, 12% with ITC is increased to 18% with ITC. It's only for other than economy. The economy class is at 5% with ITC. That continues to be at 5% with ITC. There is no rate change there. Passenger transportation by motor vehicle, earlier it was 12% with ITC. Now it is 18% with ITC. So what happens essentially here? Generally, the motor vehicle, passenger transport through motor vehicle is actually a restricted credit under section 17(5), which basically adds to the cost once you basically add 18% to your cost rather than 12%. GTA transport of goods, you had an option 5% reverse charge forward charge, 12% forward charge. Now this 12% forward charge has become 18% forward charge. Transportation of goods by rail transport, 12 has become 18. Pipeline transport of petroleum, 12 to 18. Renting of motor vehicle, 12 to 18. Renting of goods carriage, 12 to 18. multimodal transport, which involves air in one of the legs. So let's say I'm sending some goods from here to, let's say, somewhere in Mangalore. So first leg of transportation will happen through air. After that, to the end point, it will happen through, let's say, by road. So in that case, what happens? It was 12% with ITC. Now it is 18% with ITC. But if it is a multimodal transport not involving air in one of the legs, means road, train, water, or whatever it is. If that is happening, then the rate is 5% with restricted ITC. What is restricted ITC? The same line of business credit can be taken, and also the amount. Let us say I'm involved in this multimodal transport where I've taken the services of a GTA as well. So I am a provider of multimodal transport service to my clients where I am going with 5% GST. However, to do this multimodal transport service, I have availed the services of a GTA, and that GTA has charged 18%. Let us say the GTA has charged 18%. Now what happens to this 18%? Can I take this credit 18% fully? No. The notification says, the provision says, it is restricted up to 5% of the value. Let's say 1,000 rupees, 5,000 rupees is the charge on 18% is 900 rupees. But still you will be claiming a credit only of 5,000 into 5%, which is 2,500 or 250 rupees. That will be the credit which will be allowed. So it will be restricted to the 5% value, which is there on that particular transaction. Offshore drilling work 12 to 18% with ITC. Yeah. So this one entry had somehow remained in this government works. That also they have shifted it. Wherever the earthwork is more than 75% in terms of the work that is undertaken is essentially earthwork. If that was the case, 12% rate was there for the government contracts. There it is increased to 18%. And next is, if any contract which had 12% rate, if it's subcontracted, then the rate of tax was 12. That is also increased to 18. Professional technical service into exploration, mining and drilling, it is again from 12 to 18, and support services 12 to 18. Job work had a residual entry not elsewhere covered 12 to 18. Earlier, what used to happen, if the job work was in relation to a registered person's goods, as in the principal is registered for which the job work is being undertaken, the rate of tax general category was 12%. Now it is increased to 18%. Admission to casinos, race clubs, IPL also, it is from 28 to 40. Bookmakers 28 to 40. There's a huge increase here. And leasing with without operator certain goods 28 to again 40. I think there are a few questions which are coming up. Harsha, do we take at the end or as we go?
Sir, up to you. We can take it at the end, sir, so
Okay,
that
done.
it does not disturb the session.
Yes. So leasing or rental services without operator 28 to 40. Why is this so? If the let's say this is basically with the vehicles which are given on leasing basis without operator, as in self-drive vehicles, if the rate of tax on the vehicle is at, let's say, 40, then the tax will be at 40. If it is at 28, now if it has become 40, then it will become 40. And actionable claims, which is betting, lottery, gambling, it was 28, it will become 40. Now, this is one thing hitting all our Swiggy, Zomato bills, where the local delivery services. So in a typical Swiggy bill, ordering food, there are probably three components. One is the food cost, which is at 5%, which is already shifted to e-commerce operator to pay the taxes. And there is a platform fee, which you get 14 rupees 99 paisa if you have observed. That is also a platform fee, which is generally, I'm just taking an example, which is also under forward charge, where the supplier was the e-commerce operator is charging tax. This one portion of the fee towards the person who is getting this particular food, the delivery executives, delivery agents portion, there was no taxes that were being charged. Now that is shifted on the e-commerce operator. Even on that, the 18% GST will be there. So typically think about a Zomato bill, food with 5% GST, delivery charge, delivery agent charge will be again 18%. And at the end, the last portion, the platform fee again will be at 18%. Now, this also has a good impact in terms of probably the credit that they can look at. However, this is the change which is shifted on the burden on the e-commerce operator. Clarification on standalone restaurants. So there was this aspect of standalone restaurants having this 18% with ITC option Now, the specified premises definition is an explanation added, which requires them to have this business running or continuing in the hotel accommodation services to be eligible for this particular, opting for 18% GST. Lottery valuation rules, yes, these are to be aligned. Earlier, in the face value of the lottery was to be divided by 128 is what the rule said. Now it should be amended to make it 128. The notification to this extent is still pending. Now coming to the time of supply. Now, this is something which is very crucial, probably somewhere where a little more of detailing or probably case-to-case situation has to be taken into consideration. First thing, section 14 has which is dealing with the time of supply provisions whenever there is a rate change, has an overriding impact over 12 and 13. 12 dealing with goods, 13 dealing with services. 14 in general scenario, 14 has an overriding impact, which means to say, even if you have applied a time of supply based on, let's say, 12 and 13, but the instances which are called out in 14 is occurring, then 14 will apply. So means to say they have given three things, which is invoice, payment, and supply. So the first element is if the supply is made before the rate change. Supply as in, it could be supply of service or supply of goods has been made before the rate change. If the invoice as well as payment both are received after the rate change, 22nd September, before that, the supply has already been made, as in the goods have been moved or the services are rendered. However, the invoice or the payment has happened later, then the new rate will apply. Invoice is issued before, payment is made after, then invoice date will apply. That is the old rate will apply. Payment is made before, but invoice is after, even then the payment date will apply, which is the old date will apply. Because the underlying point is supply is made before. So that anything that joins along with the supply, that particular date will be considered. And the next situation is supply is made after the rate change. However, invoice as well as payment has come before the rate change in the old rate. If along with the supply, either the invoice or the payment is coming after the rate change, then automatically the new rate will apply. This is what the provision says. Same thing will go even with respect to the debit notes arising on that particular transaction. So this has a specific impact, of course, on the real estate transactions, more specifically, at least goods. Generally, it is something which could be looked at. Especially in respect of goods, there is this concept of sale on approval basis, which has to be also looked into, taken into consideration. And in that situation, accordingly, you'll have to see when the 6 months period is ending, and accordingly when the payment as well as the invoice is happening. That is also something that we'll have to consider. For real estate transaction, our continuous supply of services where certain civil works are happening, there also it is important for us to consider this particular provision. Their milestone based billing or a stage-wise billing is there. So we'll have to see what stage of work is completed as at 22nd September. Better to raise an invoice as well as consider that as concluded till that particular stage or whenever that particular timeline or the milestone is basically coming up. Because this has been a point of issue at various instances. Many people, government contractors especially, are knocking the doors of the High Court to get the differential GST refunded for because of probably non-application of the correct time of supply provisions. So time of supply provisions are something which are to be looked at. Next, coming to the certain other trade facilitation measures which are there. So risk-based provisional refunds for zero rate supplies to SEZ. Here we did not have the provision before for SEZ supplies, the provisional refund. Now it is allowed. However, the risk profile is considered and then the provisional refund is generally given. And low value export consignment, if the value was a meager amount, then the refund provisions was not there, that is removed. So small exporters, especially this is probably due to increase in small articles being exported. Let's say this Shopify and other platforms are used basically to export a lot of transactions. So that is probably helping them. The unit value may be very less, but still they'll be eligible for the refund. Coming to the simplified registration method. So simplified registration, what they say, they have promised a 3-day automated registration approval. Automated is what they say. So that is something which we'll have to watch out for. The condition is the liability should be less than 2.5 lakh per month for B2B transaction, which means to say they are essentially retailers. The tax liability which is coming up on account of CGST, SGST, IGST, all three put together in a month is less than 2.5 lakhs. Who will determine this? It's a self-assessment. He should be sure that it is on an average less than 2.5 lakhs per month. So the government's claim is 96% of the applicants who essentially may be the retailers or probably who are at the end of the value chain who may get covered in this particular situation. Simplified registration for small e-commerce operators where they have multiple places of business in multiple locations. They are basically having this particular benefit. They need not have a principal place of business in every state because e-commerce operators requires to register in every state where they have their customers. Amendment in place of supply. So what is amendment in place of supply? Now, if there is a commission which was earned, so this is something which is not just long standing from GST, it is long standing even from the service tax regime. What is this? If I am getting a commission for having facilitated a transaction from outside India, this was taxable by virtue of 13(8)(b) under the GST. Similarly, it was taxable even in the service tax regime based on the place of provision of service rules. Now they have removed this rule. Now, once this 13(8)(b), which is dealing with the place of supply for intermediary services, is removed, automatically the residual rule will apply, which is 13(2). As per that, it is recipient based. Since the recipient is located outside, who is actually paying us the commission, this will be considered an export of service. However, the flip side of it is, if we pay the commission to a person outside India, we become the recipients. So it will become an import of service and we'll have to pay the taxes under reverse charge. Clearly, it is to the exporter's benefit who are earning commission. GST tribunal, we have already discussed, 1st April 2026. Up to that date, if the orders are passed, then 30th June is the due date. Order passed after 1st April 2006, 3 months from the date of order. There is an extension provision also which is applicable. We'll have to, with sufficient cost, the extension can also be applied to. Now, coming to this circular, which has discussed or clarified to a major extent the post-sale based discount, circular 251, which is issued 12 September 25. It talks about 3 situations. One is the input tax credit on commercial credit notes. Without giving any reason, some discount, some credit note, some incentive, whatever be it, if it is passed on by way of a commercial credit note, the supplier can issue the financial or commercial credit note, but cannot reduce his original liability because, of course, to reduce the liability that he has initially paid, he has to comply with the conditions of the section 15(3), the clauses of the section 15(3). However, the earlier circular had already clarified, 92 had already clarified that there is no requirement to reverse the ITC. The same point is reiterated here. If the supplier has issued a financial credit note for any sort of a discount, which is basically a commercial credit note, then to that extent, there is no need to reverse the input tax credit. This is addressed from the perspective of the ITC reversal portion. Coming to the post-sale discounts, if this is more a post-sale discount, where the consideration is basically for promotion based discounts or season based discounts, the quantity based discounts, whatever be it, if any such discounts which is basically to promote the sales, the government has finally recognized that this particular circular has finally recognized that it is a self-service. It is nowhere having any impact on that particular party. If you sell more, you get more. So basically there is no service is what they say. You can't impute a supply here is what the clarification is given here. This takes care of most of the transactions. However, if the dealer undertakes certain specific promotional activities, what is the specific promotional activities? Let's say there is a newspaper advertisement where it says Hyundai car dealers advertisement. Below that, all the dealers, that particular dealer, say Pawan Hyundai, Advait Hyundai, their branding is also there. So these are more like a joint promotion schemes or advertisements or co-branding services where there's a clear element of supply, and they have clarified that there'll be a tax on this. And the last element is where the manufacturer gives certain discounts to the distributor, which probably is expected to be passed on to the customer or whatever be it. Now, what they bring out as a fine demarcation is there are 2 transactions. One, the sale from the distributor, the manufacturer to distributor, one leg of transaction which is completed there. The second leg of transaction, which is basically the next transaction, which is a separate transaction, which is a principal to principal transaction. And then they say it is merely to reduce the sale price and not inducements for any further supply. They give a discount so that you basically take that benefit and sell it at a reduced cost and acquire the customer. Such discounts are not treated as consideration. However, if the manufacturer has an agreement with the end customer to give a discounted price, then that could be something which will be added to the consideration, because the consideration definition very clearly covers even the inducement of supply. To induce the supply, if as an inducement of supply, if any consideration is paid, that will be added along with the value of supply. So in short, if the commercial credit notes are issued without reduction of output liability, then as a receiver of that particular commercial credit note, I need not reverse the input tax credit. And if there is no obligation, or if there is no condition that I have to do something in return, which is well recognized in the second portion, where it will not be considered as a service to them. And of course, there's no need to reverse the GST as well, because it will anyways come as a commercial credit note. And the last portion is for the principal to principal transaction, where they are saying, unless the end customer has an agreement with the principal manufacturer, there is no GST impact on that. Coming to the next portion on anti-profiteering. Now, this is something which has been a lot of news, discussions, and has been a cause of concern for many dealers. This is something which we'll try to discuss, and I'll share my perspectives as well. Now, what is this anti-profiteering? Section 171 of the CGST Act contains the provisions of anti-profiteering. What does it essentially say? In case of reduction in rate of tax or increase in ITC, this benefit has to be passed on to the recipient by way of commensurate reduction in price. Commensurate reduction. I think the most important three elements is there should be either a reduction of rate, increase in ITC, benefit has to be passed on. How to pass on the benefit? By way of commensurate reduction in price is what they clearly say here. This is the mandate of 171. Who will enforce this? 171.1 is the first clause which we discussed. 171.2 basically talks about an authority which can be constituted by the central government, or an existing authority who can be given the charge of taking care of this anti-profiteering provision. So what it says, central government to constitute or empower an existing authority to examine the case of anti-profiteering. How these cases come? Me, you as a customer, we have found out certain issues with respect to the pricing. Maybe a simple example, if I have to say, this there was this particular issue of 5% to 18%, which was there as an issue for let's say ice cream parlors. Whoever is into ice cream parlor, they were considering themselves as a restaurant. Now all of them had kept the same price, basic price. Instead of 5, they did it 18. Now that's a classic case where 18% gives them the credit, but no reduction in the basic price or the end price has happened. So these kind of issues, if someone has written it to the anti-profiteering authority to take up this particular matter along with the sufficient evidence, they would undertake an internal review of this particular complaint. And if that is found something which has a relevant evidence to take an action against, they will initiate the anti-profiteering proceedings and the notice. Now, initially this anti-profiteering authority, this was followed by Competent Commission of India, where the Competition Commission of India was designated with this authority to take up the case of anti-profiteering. However, the CCI expressed that they would not be taking up these matters, probably due to the different domain of GST and the domain of CCI, because CCI mostly works on probably monopoly and competitive pricing or deep cut pricing, these kind of issues. So that's when the GST tribunal was designated with this role of anti-profiteering related provision. And eventually the the anti-profiteering authority who are designated, CCI or the GST tribunal, central GST tribunal, had a sunset clause from 1st April 25, which means section 171 subsection 1 spoke about the need for passing on the benefit. 171 subsection 2 spoke about the authority who can take up these matters and investigate this issue. Now, after this, the sunset clause is issued on 1st April 2025 to say no new complaints will be taken under the anti-profiteering authority. The existing complaints will be discussed and it will be taken to a logical end. That is what was the conclusion was drawn. Now, when this issue came up, after the 56 GST Council discussion, I think there was a clarification also saying that they don't intend to bring back the anti-profiteering authority to take up these matters, and the intention is clear that let the market forces drive the pricing and the customer choice, and anti-profiteering authority will not get into this particular ambit, or since the sunset clause is already there, they don't want to reinitiate, is what the oral clarification that has come up in the press release. However, 171 subsection 2 has its own powers. The government can at any point of time, based on the recommendations of the council, they can empower the authority to be an anti-profiteering authority. We have been seeing reports that the government has sent notices or the requirements to all the commissionerates to have the list of products pre and post prices are being monitored. It may be for their internal verification purpose. Probably they have said for 6 months this monitoring should happen. They've given a schedule of about 40 goods, including mostly the goods which are exempted. They want to see whether the rate before and rate after is same. They want the field formations to capture the brand name, the HSN code, rate before the rate change, and the price MRP before the rate change, MRP after the rate change. That is what they want to capture. We'll have to see how these things take shape once it goes forward. Secretary informed in press release, that is already discussed. Generally, how this anti-profiteering is seen. In anti-profiteering, whether the price reduction has happened or not is not from the basic price. It is invoice plus taxes on the total price which the customer sees in the invoice. The final invoice value before and after will be compared to see if there is any reduction in the price that is actually done or not. Now, the Reckitt judgment of Delhi High Court has actually dealt in detail about the anti-profiteering related provision, how and what aspects of it. We'll also briefly discuss about that in the coming slides. But though we discuss this for our discussion and academic purposes, but I think what remains as a point for us to consider or probably convey is that there is a mandate under 171 to pass on the benefit. However, there is no authority which can enforce this particular thing, because the government has considered in its wisdom that let the market forces drive this particular aspect of it. Okay, there is a lot of discussions that is happening on Legal Metrology Act, the circulars that they have issued, what it is and other things, whether that has any bearing on this. Of course, the subject of this particular release, which is done by the government, the relevant department of the government, in its 9 September 2025 release, clarifies certain things. The subject very clearly says the intent is basically to, in the backdrop of the rate reductions by the government, they want to take up this particular issue is what they have said. What does it say? They talk about 3 categories of people: manufacturers, packers, and importers. What they do? They deal with pre-packed commodities. They will have to go with the they are permitted to declare MRP on unsold stock after inclusion of increase in the amount of tax or after reducing the tax benefit. Either ways, increase or decrease is something which is allowed. This MRP should be in addition to the existing MRP and should not be obliterated. Both should be carried in the same package. Changes in MRP can be either by stamping, stickering, or online printing. That is what they say. They say that before doing this particular thing, they'll have to give a newspaper announcement in 2 newspapers, give a circulation notice to the Legal Metrology Department regarding this decision to go with the revised MRP, and also notice to the dealers who are basically dealing with that product so that they can implement that particular change. What about the packages? Packages is already pre-printed. They say it can be used up to 31st December or it can be used even thereafter as per the said provision, and they can the only thing is that has to go with the new MRP as well. Now, under which provision was this release issued? This is issued under Rule 33 of the Legal Metrology Packet Commodity Rules. Now, what is that talking about? It is basically the power of the government to relax the application of certain provisions. Under that particular rule, this particular release is given. Basically, the circular or the notification, whatever is given under Rule 33. So, which means to say this is more a responsibility not of this, definitely is not a responsibility of the resellers. This is the responsibility of those who are dealing with the pre-packed commodities. So this has to be initiated only by them if the situation calls for so. However, there are various other product-based regulatory authorities which are there. For example, the National Pharmaceutical Pricing Authority, which has given a memorandum that the manufacturers must comply with this particular provision and issue this particular revision as based on the provision. So this is something that we'll have to watch out for. But from the GST perspective, the applicability is rate reduction. Whether the rate reduction is happening by way of a revised MRP or actually you are giving it at a reduced price doesn't make any difference. What is more important is we should be in a position to substantiate that the rate was before so much and rate is after so much. And one more thing is the anti-profiteering provision basically the Section 73 or 74 notice cannot be issued for the anti-profiteering provision because it only talks about taxes not paid, short paid, input tax rate excess availed, erroneous refund. It doesn't talk about the non-passing of the reduction in price. That is a subsidiary and essential connected provision to the other consumer-centric requirement of the provision. Now coming to this record Benki sir judgment. So what is the background? They are dealing in a lot of products. Maybe most of the things that we use, Harpic or major things that we use for our day-to-day use is under them. So there's some rate reduction in November 2017 where they said that the rate reductions were not being implemented. What were the findings? There was no reduction in rate of tax. However, this was the conclusion of the Anti-Profiteering Authority. What was the issues that they were raised? Whether the respondent passed on the benefit of GST reduction 28 on Dettol as required under 171, whether the increase in grammage, this is something which is also relevant for us. Instead of decreasing the price, can I increase the grammage? Instead of giving, let's say, a small sachet of shampoo, it is 10 ml, you have increased it to 11 ml for the same price. Is it equal to the commensurate rate reduction? Whether it will amount to the passing of the benefit? Whether can you take the reduction of lot of expenses like cost increase, fluctuation cost, other things to offset this reduction in rate? That was one more issue which was there. And whether the profiting, whether we should have to consider on an overall basis or a transaction basis or a customer basis was one more thing which was there. What was the findings of this particular authority? 28 to 18 for 1511 required to pass on the benefit by way of commensurate price reduction only. The base price reduction had to be done. Grammage increase is not accepted is what the authority had opined. Passed an order. Sorry. So commercial reasons like forex cost, custom duty, all these things cannot be accepted. There should be a clear demarcation is what they have said. There's a contravention of section 171 and they were directed to deposit the amount, which is 10% of the profited amount is generally the amount which will be considered as the penalty under this particular provision, which were held to be deposited. This was the outcome of the judgment. They went to the High Court challenging the constitutional validity of section 171, which deals with this, and also on various observations which have come. In essence, this judgment has gone against the assessee and they have said grammage is right, grammage is not right. You'll have to really go for that. And you have to go for a SKU based, product based, SKU based allocation of benefit that you'll have to look at and then pass on the benefit. And the constitutional validity of 171 is upheld, having discussion and bringing about various other related provisions which are there. And then finally, they have said, the court has said, the presumption that any tax reduction in the rate must lead to commensurate price reduction is rebuttable. So the only option that the government gives or the act gives is to give a commensurate price reduction. You can't pass it on by way of increase in grammage, or you can't pass it on as freebies. You take this along with that, I give one more item along with that. So that is not commensurate price reduction. So buy one get one offers, or buy little get more offer. So these things will not result in commensurate price reduction is what finally the court had said. And this was the conclusion of that particular judgment. Now, that judgment, though it was in the context of a period where the anti-profiteering provision and the national anti-profiteering 171(2) was effective, I think we'll have to closely watch out how the government wants to probably take up this particular issue. As of now, if the rate reduction is there, and probably that is something that is better to pass it on, though there is no mechanism to basically enforce 171 subsection 2. However, 171 subsection 1 casts a burden that you'll have to pass on the benefit. Now, since this is something that is part of this particular provision itself, there is no relaxation. I think it is better to at least compute whether there's a reduction of price or not, because many instances, many manufacturers of opinion that there is no price reduction at all, because if it is exempted, the input cost is way more than what is their GST amount that they could have otherwise taken it. Coming to certain issues, how long we have, Harsha?
We have 5 to 10 minutes more.
Okay, fine.
You can take it.
Yeah, ITC on accumulation on rate reduction. So this is something which is a classic issue. The rate of tax on output is reduced from 12 to 5. Of course, what happens here? The credit that would have got accumulated when you had purchased the product at 12% may have still been there in your account. Now, can you basically claim this particular refund is one issue. Now, to this issue, if you refer section 54 relating to the inverted duty structure, it plainly says the rate of tax on input is higher than the rate of tax on output. But more practically, what we see, we associate this more with the manufacturer or service industry, where we see the rate of tax on inputs which is used in the manufacture of output is being compared. Rate of tax on agarbatti, all the inputs are at a higher rate, output agarbatti is at a lower rate. So that's a case for inverted duty structure. Leather products, inverted duty structure. That's what we see. However, there is no such restriction that it should amount only on account of manufacture. However, Circular 135 has clarified that you can't claim a refund when the output and input are same and there is a rate reduction. This circular is something which was subject to challenge. Couple of high courts have made some observation against that circular and said that there is no such restriction in section 54 and the refunds were to be considered. So this is something that we'll have to look out. If the amounts are substantial, accumulations are substantial due to rate decrease, let's say especially 28 to 18, probably that is something that you can look at and then suggest the client if they want to go for that particular option. Because once you file a refund application, the amount basically gets reduced from that particular refund amount. So probably you are looking at a choice of whether you want to contest this issue till a particular stage, or you are looking at using it for your regular supplies over a period of next 6 to 8 months or 1 year. So based on the facts and circumstances of the case, this is a decision that we'll have to probably involve in and probably suggest the clients. Term insurance, again, life insurance, all these are exempted. However, there's a huge amount of credits. If you see life insurance and term insurance, lot of credits will be there in this particular business. This is something which they'll be losing. We'll have to see whether they'll really be in a position to reduce this particular rates. This is something which we are not having an idea as on to date as to how they would want to give the rate reduction. Rate reduction on common man items. Of course, this is something which we have already discussed. A lot of products, especially food products, even the residuary category of food products are done at 5%, which means there could be a situation of ideas for the temporary period, which we'll have to figure out if you want to go for a refund claim or take it ahead. And next important thing is wherever the goods are exempted, scale, pencil, eraser, sharpeners, books, all these, wherever it is exempted, there's a loss of input tax credit that will be there. As per section 18, if any product which was taxable has been notified as completely exempted, then the inputs contained in semi-finished goods and in finished goods are to be reversed along with the capital goods related credit. So this is an exercise that they'll have to carry out, and the related cost has also probably should be considered in case if they decide to pass on the benefit or not. Now, what is 18.4 saying? Whenever a taxable product becomes exempted, the credits which are lying in inputs and capital goods and inputs contained in semi-finished goods are to be reversed is what it says. So this determination should be first stock to input based on the HSN and then correlate with the invoices. And the form which has to be filed has to be accordingly filed with the breakup of the invoices and how much of credit is being reversed now. So this is something that's an exercise that has to be definitely initiated, and the stock positions are to be taken for this particular transaction. And most of the food products are at 5. AC, TV, dishwash, etc. are reduced to 18 from 12. Agricultural goods such as tractors, agri machineries, composting machines are brought down to 5. Drones are also brought down to 5. Agricultural use drones, or any drones for that matter, are brought down to 5%. However, we'll have to watch out, because whenever the purpose is agricultural based, there could be a reduction of 5%. However, something which is, let's say, some part is used both for tractors as well as other goods, that we'll have to watch out if it really is available as an exemption or not. Based on the notification, we'll have to probably suggest the client. Now, rate of reduction on cement, 28 to 18 is a huge amount, and let's say 20% of your cost of construction could be on account of cement, what will happen there? Will you ask for the passing off of the benefit? This is something that you can of course ask, but I think in there is a discussion, a good amount of discussion that has happened in the Delhi High Court judgment about the real estate sector, where they have also said you can't do an input output ratio based mechanism, purchase and sale based mechanism for like in the goods for the real estate sector. You will have to look at the project overall benefit due to various reasons peculiar to the real estate industry, and then pass on a per square feet basis to the customers. That is what the judgment has said. So this is something which could be a point of debate and discussion between the builders and the customers, which we'll have to see where it ends. Most of the medical equipments are 12 to 5 or to nil, and declaring MRP, who has the obligation when it is developed, is something which we have discussed. Quantity based, keeping the quantity grammage increase, something which is not allowed, is what the courts have already said. And accommodation service 5% without ITC. Okay, this is one more thing. So we spoke about 18.4 where taxable goods becomes exempted. Now the stock what we have, it's inputs contained in semi-finished or finished goods, or the capital goods are to be reversed. This is a case where it is exempted as per 18 subsection 4, the provisions are applied. However, as we spoke, there are various services which comes with a restriction of input without ITC at 5%. Now what happens there? 22nd September and onwards, whatever they do, their inputs will be restricted. Their output will be at 5%. And essentially, if that is the only business, they end up paying cash. Simple. However, are they obligated to also reverse the credit on account of stock that they have, on account of equipment that they have? Let's take an example of gym which is purchased, which is there 1 year before. 1 year before the gym is set up. All the equipments are purchased. The entire credit is claimed, right? And this credit is used against their 18% GST, which hitherto they were paying. Now, as soon as becomes 5%, whether this credit be carried forward, whether this capital goods credit, because capital goods credit is expected to span over a period of 5 years, whether for the balance 4 years should they reverse the credit is something which is a point of concern. As on date, based on the my understanding of the provision goes that this is not a case where it is completely exempted. The explanation added to this rate notification, which talks about 5% without ITC, says for the limited purpose of section 17.2 and rule 42.43, this particular mechanism has to be followed. There is no specific reference to 18.4. Also, if you refer the exempted definition, it specifically says wholly exempt or nil rated is what it says, which means there is, as on date, there is a good amount of chance that you can probably take this credit unless we probably get some circular or something against this. As on date, this is one gray area which could be there, which the client has to decide and probably then take a call on it. Standalone restaurants. So this is something which we have already discussed. What the business should do: review the stock of goods, time of supply cross-check, consider the updates in HS22. So every once in a while, this HSN codes get updated as part of their India's arrangement with the global countries as per WTO. So HS 2022 updated a lot of rates, which has an impact in the customs and also taken in the GST. Probably our 4-digit level may not have changed, but the 8-digit level may have changed. We have, at least after this notification, couple of instances where we saw that whatever they were using as a HSN, since GST implementation was not at all there, because HS 2016 or 17 itself has changed this particular HSN. That is what we could sense in a couple of instances. So I think it's important as a since this exercise includes the review of HSN for the purpose of rate, it is also better to see the 8-digit HSN level as per the customs tariff, which is based on HS 2022, the updated one as per the WTO. And next is revisit tax clause in ongoing agreements. Real estate companies take a position on the projects as on date because they'll have to pass on the benefit probably. Government contracts 12 to 18, wherever it is happening, they end up paying 18. Now they'll have to see if they can go for writ to basically recover the balance additional amount which they have got. Karnataka High Court has given many decisions to many contractors, allowing them to go for a refund of the balance 6% which they have paid to the government, because the contract would have been entered at 12%, but the rate finally paid is at 18. Differentials being given. Discount policies to be revisited in light of the circular. How the wordings are there is something that has to be carefully considered. By end of the day, what appears to me is that if there's a link between the price at which you are selling and the price at which you are getting, the discount is being given, then probably that can be considered as an additional consideration. Otherwise, all other quantity based and value based discounts which is not linking to your sales is something which is allowed. I believe there's no issue there. Assess the need for price reduction and revised MRP, bucketing of ITC into the exempt credit and whether it is specifically for taxable, rule 42.43. And last one is on rate inversions, which we have already discussed. Rule 54.3 doesn't have a restriction. Circular 135 has a restriction. Judicial precedents have gone against the circular 135, which is something which has to be considered. 18.4 discussed. So this is something. This is what I was saying. 18.4 talks about taxable product becoming completely exempt. Explanation 4 talks about it will be deemed as exempted only for the purpose of the section 17, which talks about credit should be commonly used. So this particular gray area is there, but till there's specific restriction, I don't see any reason that you should not be claiming this particular credit. We can take the questions. If there are any, I'll just stop my presentation.
Thank you, Subramanya sir, for that enlightening session. We will now open the floor to discussion and questions. Participants, we have 15 minutes of Q&A. Please post your queries in the chat box. We will answer them as much as possible. Thank you. Sir, can I start, sir?
Yes, please.
First question is from CA Kiran Kumar. Life insurance renewal premium due on 29/25, but paid on or after 22/9/25. Is GST exemption applicable?
So technically, the supply of service has happened on 20th September that way. Invoice as well as payment, if both are happening post that date, then the new rate will apply. That is what the provision says. But technically what happens, the invoice will be issued on the date of issue of policy itself. I'm not sure whether they can issue a policy from a retrospective date. In my view, it will be only from if you have crossed that last date for renewal, you have crossed it, you are paying later on. Invoice as well as the policy will be issued on that date only. So it will be the new rate which will be exempted. So probably you'll have to just take that chance of 2 days and renew it later. That's what I feel.
Next question is relating to hotel accommodation. What if one room is 7,500 per day? What rate is applicable?
7,500, more than 7,500 is 18% only. It is same as what was there before. Below 7,500 was actually at reduced rate of 12%, which they have done as 5 without ITC. So that way more than 7,500 is 18, less than 7,500 is 5 without ITC. And if there's a restaurant which is accommodated, which is their part of it, they have an option to go for either 18% with ITC or 5% without ITC.
Okay. What if B2B liability exceeds rupees 2.5 lakhs after getting simplified registration?
Okay, so this is an optional mechanism where you have to opt to get into this particular mechanism is what they say. We don't know what else or what more they will link this to. As on date, there is no notification as to how this particular thing will be implemented, and they have very clearly said it's self-assessment. So if you are out of that, then if the benefit is only limited to the registration aspect, then it really makes no much difference, because day one you have done the registration expecting your turnover to be less than that, and after that, only thing is if they add more types of benefits to this class of people, probably that is when we will have to look out if there is any impact. But as on date, we are not in a correct position to comment anything because there is no notification.
Next question is, what's the threshold to qualify as a small e-commerce operator?
No, there is no threshold, I believe. It is basically for the benefit of the e-commerce operator where the registration is being simplified. That's all. So all the e-commerce operator will actually get that particular benefit.
Is Circular 251 retrospective?
Circular is always clarifying a position of law, so its application should definitely be retrospective. And in fact, if you see, the circular is referred due to the trade issues which are raised, representations which are raised, and it also refers to Circular 92, which is of 2018. So all of that definitely indicates that it is retrospective anyways.
There are few letters issued by the Director Legal Metrology, Ministry of CAFPD, regarding how to handle MRPs in line with changes in GST rates. Where to get that extract? In the website, they are not finding it. Is there any other way?
Maybe that is something, whatever we have come across till now, that is something which we can probably merge and share it with all our participants after the session. I'll share it with the team.
Okay. Is notification with respect to intermediary services issued?
Not yet. Not yet.
In the third scenario in Circular 251, where there is an agreement between manufacturer and end customer, the manufacturer needs to raise a commercial credit note on dealer, and dealer needs to change the manufacturer as supply of service for discount on inducement. So the intention is to avoid GST credit in the hands of dealer. Is that right? There wouldn't be any impact on GST collection to the government. Is that right?
Okay, so the third situation is basically talking where the manufacturer has an agreement with the end customer. At least to my knowledge, I have not come across any such situation. Maybe someone else can probably pitch in if they have come across this situation where the customer has an agreement with the manufacturer, with the people in between being a pass-through. But yes, what it says, if you have an agreement and if some discounts are expected to be passed on, which is definitely something which is committed to the customer and passed on through them, then this would be a consideration for inducement of supply is what they say. So they don't link this with the service transaction. In fact, they link it with the underlying goods transaction, and they say the value has to be increased. So there is no service, to my knowledge, which is discussed here. It is not promotion or it's not any other part which is there. It is basically addition to the value, because consideration includes anything which is additionally given for the inducement of supply. So it will be treated as goods. The addition will also be treated as goods and accordingly taxed.
Legal metrology letter gives some direction for manufacturers, importers, and all. What would be the suggestion for small retailers? How should they handle their?
They are bound only by GST Act. They are not bound by the Legal Metrology Act. So it will be incumbent on the manufacturers to see if they are really required to do this.
So what is the GST implication of service advance in case of rate changes in case of wellness centers like gym?
Okay, so wellness center, we have got the advance. Services basically post, let's say we have booked a wellness center booking as on date. So there are two situations. As soon as you make a payment of advance, you get a receipt voucher where the invoice is basically raised once they actually visit there. So that's upon completion of service basically. So completion of service is happening later on, service is happening later on. The amount has come now. So as per the receipt voucher, you would have paid say 18%, which will eventually get adjusted against the 5% GST. Because two things are happening thereafter, new rate will apply.
Okay. For beauty and wellness, is 5% without ITC optional or mandatory?
It is mandatory. Even the circular, the clarification, there are a couple of FAQs which are issued. The latest FAQs has also clarified wherever they have said 5% without ITC, it is compulsory. This is something which is right from the restaurant category where they added an explanation saying that this particular entry 5% you can't do optional. It is the restaurant is mandatory 5%. That same explanation is, I think, applied for all other entries as well.
Can we consider the GST rate change of 5% from 12% in case of furniture of bamboo, rattan, and cane? But is there a change in rate for a dealer who makes sofa, chairs, and table or other furnitures? They buy parts and attach and make them, not from point of view of job work, as there is no specific contract.
So 9403 is furniture, basically sofa, the tables. It was 18. It has stayed as 18 to my knowledge. It has not reduced. Maybe they have a little, they are better placed because of probably a reduction in the rate of their inputs.
MRP change responsibilities on the pharma manufacturer only. What is the responsibility on pharma distributor for his existing stock? What is the responsibility on pharma retailer for his stocks?
So again, this pharma is again option or one of the categories who are getting covered under the Legal Metrology Act, like any other manufacturers. Principal responsibility is definitely on the manufacturers. However, the National Pharma Pricing Authority, I believe, they have given a circular stating that they have to apply, they have to follow this particular mechanism which is there in place and go with the rate reduction and go with the implementation of these revised MRPs wherever it is applicable. And they also say it need not always be that you'll have to stick a new MRP. Even implementation of rate change through circulars, basically their pricing list, which should be followed by the customer, by the pharma retailers, is something that they have basically given as a clarification. That is also something that we'll add it in our documents list, which we can share it.
Some of the HSNs are not covered in notification. How to handle these?
So the updated notification, to my knowledge, has everything. If that is not there, then there's this residuary entry, which is one entry which for any product which is not there. But I think most of the products are covered because this is not an amendment or a incremental notification. This is a complete notification covering all the goods in one notification taxable, all the goods in exempted. Probably you'll have to search the exempted one. If it is not there, then probably it could be taxable at the residuary category at 18%. Earlier it was entry number 453. If I'm not, I think we'll have to now see what is the entry.
Okay. How post-sale discount due to an inducement of supply to be reported in GST return?
So it's an addition to the value. To my knowledge, it should go as a debit note.
Okay. Manufacturer of student notebook, supplier of paper is expressing that he will charge 18% GST, even though GST is exempted. My cost will increase as I have no option for refund. What is the
No, I
position?
think there is no bifurcation. Anyone who is dealing in notebooks will have to go with the rate of exemption only. And the law does not provide you to charge a tax when the product is exempted.
For existing inventory, revised MRP, and for new inventory after 22, increase in grammage. Can we do this?
So increase in grammage is also, I think it will go back to the same point, because whatever we are looking at as a commensurate price reduction is not just for the existing stock. It will definitely be even for the fresh stock. So that has to be something which we have to be considering. And if the question is on grammage, then yes, the grammage part is something which which at least the Delhi High Court has said not applicable. But in my view, the crux here is how do we interpret commensurate price reduction? Now, I think since last few years, there's also this concept of having this per gram per ml rate as well. So, which in fact very clearly shows that once the grammage is increased, the per ml rate reduction is already done. But as on date, we have a non-assessee friendly judgment which says that grammage increase is not possible. That is something which we'll have to look at. And of course, there's one more open issue, which is with respect to this, let's say 1 rupee shampoo packet. If you can't increase the gram, then it will go to 0.9 rupees, something like that. This particular rounding off error is also something which is there. I think the Legal Metrology Act also has a provision regarding the rounding off to the lowest rupee, which may or may not work for many small products, 3 rupees, 5 rupees, 1 rupee products. So that is something that we'll have to wait and see how that takes shape.
How to relate section 15, subsection 2, clause B with circular number 251?
15.3.
They
15.3.
stated in the question as 15.2B.
Okay. 15.3B, I'm not sure.
Maybe.
So 15.3B says I think now that the condition is something which they want to dispense with, linking of invoices and reduction. So I think that 15, once that is not part of 15, it will automatically become a commercial credit note. And once it's a commercial credit note, then you have the benefit of claim of input tax rate. You need not reverse the input tax rate, is what the circular says. So I think it is quite correlatable, I believe.
Okay. Invoice raised before 22nd and the goods are in transit. Then which rate is applicable?
So supply is what is important. I think supply, to my knowledge, once it is going out of your place, if you have raised an e-way bill and moved the vehicle, I think supply is done. So once the supply is done, and the invoice is also raised, the old rate should apply.
Is option of forward charge mechanism or RCM with 5%, like without ITC, still available for GTA?
Yes, it is still available. It is not 12% now, it is 18% with ITC or 5% without ITC.
Okay. Implication on clubs having room facility. What are the implications?
So clubs having room facilities still stays the same. It's again based on any other entity with level 7,500 tariff or not. So I don't see any change there.
Is there a rate change for RWA associations?
No, it is anyways 18. They have retained there.
Okay. Section 194R of IT Act perquisite any GST applicable or treated as discount and no GST as per latest circular.
So there is no specific correlation between 194R and this circular. I always see 194R as probably a plausible point or a starting point to further venture into and see if there is a need for any GST there. So not every benefit that is coming out needs GST. That's more on a different footing, that it is basically to have the TDS and have those transactions recorded. However, GST requires a supply to be there. So it may be a benefit which is given, but need not be a supply, because benefit, whether you do something or not, you may get some particular benefit. So that doesn't mean that you have done a supply. So to my knowledge, 194R is a starting point. You'll have to really look at the other elements, whether it exists or not, and then finalize if there's a GST levy.
What happens to accumulated cess? As cess has been
This is
removed.
one thing which we have missed out to discuss. This is one more open issue which is there. As on date says, there is no clarity how this is to be done. Like how we got as a cess related issue with respect to the transition from service tax or central excise to GST, where cess effectively could not be claimed at all, is something that could happen here as well. I think that is the reason most of the manufacturers, the car dealers, are trying to offer the price discount and clear as far as possible. Henceforth, after 22nd September, there is no cess. And one more thing that came up for discussion is, right, like 18 subsection 4. 18 subsection 4 says once the product has become exempted, which was taxable has now become exempted, then the credit has to be reversed on the stock. That is what it says. Now, as we know, the CGST Act is mutatis mutandis applied for IGST Act as well as this Compensation Cess Act. So one issue that came up for discussion today in one of the groups that we were looking at is whether it will be considered as exempted from cess. The cars are exempted from cess, which requires you to reverse the credit of cess concerning the stock which is there. That was one point which came up for discussion. My view on that, now there is, like the CGST Act, there is no rate notification and exemption notification in cess. You have only the list of products which are taxable under cess. That is what it says. Once these cars are taken out from that particular notification, as on date, I think as we stand, I don't see the cess notification being issued. That is something which you'll have to watch out for. I don't see a possibility of exempting from cess. It is only taking out from cess. So which means Rule 18, Section 18(4) will apply only when a product has been exempted, not when it is completely taken out from the levy itself. So, which probably is one factor that I'm just, my view is there is no need to reverse the credit. However, you may really not be able to do anything else with that particular credit. We have to wait and see. It may become a cost, as it has been with the secondary and higher education cess.
With regard to your point on 18.4, there is a question for with regard to multi-product line and the 18.4 section.
So multi-product line and 18.4 will really not make any difference, because multi-product line may have 18.5 exempted, whatever be it as on date. For that particular product, what is the stock, what is the material which you have used in that particular product is what you actually ascertain. So basically you go to the root of that particular product and see what credits have gone into that, and then you reverse it. So that way, having multiple products may not really impact 18.4. You will apply 18.4 only for that product which has become exempted. That is one time exercise which you do. And later on, of course, Rule 42 and 43 will apply. And of course, the capital goods is something which is very important there. If the credits are, let's say a laptop is purchased in a multi-product line case before, let's say 2 years, then the 3 years credit has to be applied, and you'll have to accordingly reverse, because the 18.4 not just covers inputs, it also covers the capital goods.
The last question, sir.
Yeah.
On passenger transportation, two choices have been given. That is 5% without ITC or 18% with ITC, as per the GST Council recommendation. Is there any change in the notification?
No, that is what it has come out as well, as I believe.
Okay. So thank you so much for your patient answer to the questions.
Thank you very much to KSCAA and all the participants who have joined today. It was, I thoroughly enjoyed my preparation for this particular session. Thank you very much.
Thank you, Subramanya sir, for that insightful and thought-provoking session. Practical perspectives and deep expertise. You went to each of the practical aspects and gave with an example that was very insightful. These have truly helped us understand the GST 2.0 changes much better. Thanks also to our participants for your active engagement and questions that were raised, which gave others also much benefits. So we hope this session has been valuable to you and has given you clarity on the recent GST developments. So on behalf of KSCA, I extend our gratitude to everyone present here today. We look forward to seeing you at the future knowledgeable sessions. Wishing you all a good and an insightful evening ahead. Thank you. Thank you, sir.
Thank you.
Thank you, everyone.